Hello everyone, and welcome back to the channel where we demystify the complex world of finance, one stock at a time. Today, we're diving deep into a stock that's flashed brightly on our hard-to-borrow screener, BIYA International Group Inc., trading under the ticker BIYA. This isn't just a generic overview, we're going to break down exactly why BIYA has caught our attention with some truly eye-watering metrics. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what exactly is BIYA? BIYA International Group Inc. operates in the technology and software application sector with a current market capitalization of about $103.02 million. Through its subsidiaries, BIYA provides essential job matching and trusted recruitment, project outsourcing, and labor dispatching services to businesses across China. Think human resource management, payroll services, and electronic contracts, a crucial service in a dynamic economy. What is cost to borrow and why it matters? Now, let's talk about the number that really jumps out for BIYA, the cost to borrow, or CTB fee. For BIYA, this fee is currently an astounding 897.1% annualized. Highlight 897.1%. What does this even mean? When you short a stock, you borrow shares, sell them, and hope to buy them back later at a lower price to return to the lender, profiting from the difference. But borrowing shares isn't free. The cost to borrow is the annualized interest rate you pay to borrow those shares. A CTB of almost 900% means it costs nearly 9 times the value of the shares just to hold a short position for a year. This is an extremely high fee, indicating that demand to short BIYA is incredibly strong, or the supply of shares available to short is extremely limited, or both. Why this stock is hard to borrow right now? Why is BIYA so hard to borrow? Several factors likely contribute. Firstly, its estimated float is remarkably small, at just 2.7 million shares. Share float number. Small float means there are fewer shares available for trading, and consequently fewer shares available to lend to short sellers. When demand to short a stock with a tiny float surges, the cost to borrow can skyrocket, as we're seeing with BIYA's 897.1% CTB. Our internal composite squeeze score for BIYA currently sits at 53.5 out of 100, reflecting this confluence of factors. While we don't have information on the exact number of shares currently available to borrow, the sky-high CTB tells you the supply is likely very tight. Squeeze mechanics explained. This brings us to the potential for a short squeeze. Imagine a situation where many short sellers have borrowed BIYA shares at that high 897.1% CTB. If the stock price starts to rise, perhaps due to positive news or increased buying interest, these short sellers face a dilemma. Not only are they losing money as the stock goes up, but they are also bleeding money daily from the exorbitant borrow fees. At some point, the pressure becomes too great, and they're forced to buy back shares to close their positions and stop the bleeding. This buying pressure, often in a cascade, can push the price even higher, forcing more shorts to cover, creating a self-reinforcing upward spiral that's a short squeeze. Show squeeze graphic. Dilution risk check. Before getting too excited about squeeze potential, we always run a dilution risk check. Dilution happens when a company issues new shares, increasing the total share count and often decreasing the value of existing shares. This can effectively offset or even negate any short squeeze thesis, even with high cost to borrow. For BIYA, we found no recent dilutive SEC filings like SMINUS1s, SMINUS3s, or 424 BS in the last 90 days, which is a positive sign against immediate dilution concerns. Recent reverse split watch. Now, let's talk about a significant event for BIYA, a reverse stock split. Just 17 days ago, on July 13, 2026, BIYA executed a 1-for-10 reverse stock split. This means for every 10 shares an investor owned, they now own 1, and the share price was adjusted higher proportionally. Reverse splits reduce the total number of shares outstanding, effectively shrinking the float and resetting the share price. Historically, we've observed a pattern in many microcap stocks where any volatility or even a price pop can occur within about a month after a reverse split. While this is a tendency and not a guarantee, it's certainly something to keep in mind for BIYA in the coming weeks given its recent split. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's look at recent price action for BIYA. Today alone, the stock is down minus 38.8%. However, looking at the past 5 days, BIYA surged an incredible plus 87.5%. Over the last 30 days, it's down minus 26.77%, highlighting extreme volatility. Two price action chart. Today's volume for BIYA is 2.725 million shares. But compared to its 30-day average volume of 10.18 million shares, today's relative volume is only about 0.3x average. This means current trading activity is significantly lower than its typical daily average, even with the sharp price drop. This kind of price action, coupled with a tiny float and the staggering 897.1% CTB, makes BIYA a very interesting case for potential volatility. Remember, a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction and are willing to pay a premium to stay short. BIYA International Grouping, or BIYA, presents a fascinating study in how to borrow stocks, driven by its small 2.7 million share float and an astronomical 897.1% cost to borrow. Add in a recent 1-4-10 reverse split just 17 days ago, and BIYA is certainly a stock worth watching for its unique dynamics and potential for continued volatility. But as always, knowledge is power, and thorough due diligence is paramount. What are your thoughts on BIYA? Let us know in the comments below. If you found this breakdown helpful, please give this video a like, and don't forget to subscribe for more in-depth analyses of stocks on our hard to borrow screener. We'll see you in the next video.